Good evening, everybody. This is my pleasure to say the few introductory words because tonight we have the pleasure of speaking with Robert Sharratt, who is not only an LBS MIF alum from, well, before the 2000s. I'll let him give you the exact year. But also, he's the author of a very challenging and intriguing book about the financial system and the 1%. And basically, if you have not read it, maybe it's something to put on the list. It's maybe an interesting journey that has led him to change his career after the LBS program. And I think after the initial presentation and the nice journey depiction by Robert, we will have a Q&A session, and feel free to write your questions, or in the Q&A you can also ask them directly if you feel this urge. So please, Robert, introduce your book and your project to us.
Great, thanks, Claudio. It's very kind of you. And so I'm super excited to be here. You know, the MIF was like a big part of my life. I mean, you know, I'm in love with London Business School, and so I'm happy to help in any way that I can. And the book really kind of starts. The idea starts at LBS. So I joined in. I graduated in 1998. So it was a long time ago. I was in my mid-20s, and I was the second youngest in my class, I think. And, you know, I had to push to be accepted because many people said you should spend more time, like, you know, getting experience. But I knew this is exactly what I wanted to do. I really was passionate about finance. I saw it as like the best business school in the world for finance. And my, you know, focus there, I mean, I did all the basic, you know, core courses and loved it. And the thing that I was really interested in, and I wrote my thesis on, was valuing companies in countries that didn't have established capital markets. So my professor helped me get a job. I worked for HSBC doing emerging markets investment banking. And it was a dream for me. I got to see parts of the world that I had, you know, never seen before. And I spent a couple of years in Russia and in China in the late 90s. And so, you know, it was just a fascinating period. It was really the Wild West. It was, you know, when I was in Moscow, like I stayed at like the National Hotel, and one of my first jobs was valuing one of their natural resources companies. And I had like, you know, I had like a bodyguard, I had a driver. It was really, you know, back in London, I lived in a tiny little flat, you know, across from the school, and, you know, certainly didn't have a bodyguard. So it was really fascinating. And it was there in Moscow that we were lending money to a Russian company. And so I went back and forth from London to Moscow, and like, you know, it got to be basically the run up to actually dispersing funds and making the loan to this Russian company. And, you know, HSBC was a small subsidiary in Russia, and we didn't have enough money. There wasn't enough money in the subsidiary in Russia to make the loan. So, you know, I'm like a kid, right? It's my first job. And I went around and said to the treasury people, like, how does this work? Like, how do we disperse the funds? Like, where does the money come from? Does it flow from like headquarters? Does it go from like London to us directly? Does it go through the Russian central bank? You know, does some plane show up with a bunch of money? I mean, I was, you know. And so finally, after, you know, I'm like, finally after like, asking everybody, I'm slightly autistic, and I also like I think in life it's really important to ask questions. So anyway, I asked people all these questions, and finally some guy in the Treasury Department said, look, Robert, we create a loan for them, which is our asset. So that's money in the future that they're going to pay back to the bank. And we create a deposit account, and then we just enter, on both sides, on both sides of the balance sheet, we enter what we're lending to them. I mean, it really, I was, I was shocked. It was, if you've studied economics, like for your undergrad, if you've read basically any textbook from Paul Samuelson's book in 1948 to Greg Menke's Macroeconomics, which is the most widely read economics textbook in US universities, you are told essentially that central banks create the money, and then there's a money multiplier, in the economy kind of theory. And so I just really, I couldn't process it, because what I was seeing was like the bank was just creating money. I mean, and I kept asking questions, and they're like, well, it's also like the full credit of HSBC is behind it and whatever. But basically what it does is it gave the borrower purchasing power today in return for a commitment to, pay future cash flow streams back to the bank. But I don't know what. So I remember sitting on like I just graduated from LBS, and I didn't. I just kept thinking to myself, like, what is money? And, I mean, what I've been told on my undergraduate, I mean, it didn't seem to be true. And, when, the thing is so I kept asking people, then I started asking people, like, what is money? And, I mean, if you've got a master's of science degree in finance from London Business School, like, you're supposed to be functioning at a bit higher level than, asking, a bunch of people, what is money? And I one of my colleagues, as a junior banker, one of my colleagues said, Robert, I hope you keep asking people that question, because it's going to be really great for like my career, because you just look so silly, right? So it kind of led me into the book. So I've been very interested in the idea of like, what is money ever since. And so part of my theory is that you have to look at essentially the origins of money. And so I've read, since that time, over 20 years, I mean, I'm kind of obsessed with it. I've read everything I can get my hands on. And there's like, where money comes from, I think you have to really look at it as essentially the memory of something valuable that was created. Because I think in the early days of human history, we specialized. You had to remember who had done what. You had to have an idea of the exchange of what that meant, essentially. So if this person essentially, whatever, contributed, this person made spears and this other person went out and did the hunting, there had to be this kind of measuring of like, what was the value of that? And money, my conclusion is that money is essentially, it's essentially a symbol. It's a symbol of value that was created. And we don't think about it today, because if you sit in London or New York or Geneva, you don't ask yourself like, what is money? Especially if you've graduated from LBS, right? It's like graduating from like, a good medical school and then asking people afterwards, what is blood? People are probably expecting you're going to function on a bit of a higher level than that. So, for me, it was really fascinating. I mean, I came across a number of quotes from Keynes, for example, where he said, there's one funny quote that I put in the front of my book, which is that Keynes said he knew of only 3 people who really understand money. I mean, 3 people, that's not very many, right? So I eventually concluded that Keynes wasn't one of those 3. And I think Keynes makes a mistake that many people mistake today, because they see money as having intrinsic value. And I think that's wrong. I think no money has intrinsic value, whether you're talking about paper money or gold or Bitcoin. I think they all just are a symbol that represent something valuable created, and they give the holder purchasing power. I think that's it. The thing that was shocking for me is that banks essentially have been given this creative power to create purchasing power. And for me, it was fascinating to realize essentially that banks are not just simply, connecting surplus capital with productive uses in the economy. That's really the Walt Disney version of what banks do. And like I try to say in the book, I think it's almost entirely incorrect. I mean, what banks are mainly is monetization entities. What they do is essentially they exchange future cash flows for giving people purchasing power today. And obviously that has a present value and a future value impact. You give somebody purchasing power today, or somebody's created something today, and that has a present value. And what banks do in exchange is they take the future value. And the future value is that you take a loan from them. Well, you have to pay back the value of that asset that's been created by future cash flows, either generated in the real economy or through the increase of an asset price or something like that. So it was a real, it was a real shock for me. And I think for many people, I mean, there's, you've probably all read the Bank of England Quarterly Journal Q1 2014, which states that 97% of the money supply comes from credit money created by commercial banks in the UK economy. And here in Switzerland, the Banque Nationale Suisse has said that it's over 90%. It's really fascinating living here in Switzerland because Switzerland is a bit of an experiment, partly in direct democracy. So they actually had a vote, believe it or not, a few years ago. It's like a science experiment on whether to implement essentially Irving Fisher's Chicago plan for 100% reserve requirement for banks. And a poll at the time asked respondents if they knew, who created most of the money in the Swiss economy. So 13% were aware that it was banks. And this is Switzerland, which is a fairly well-banked country. So you'll be surprised to know that initiative didn't pass. Switzerland's maybe not the right country in the world to try and implement 100% reserve banking. It's kind of like trying to outlaw chocolate or something like that. So my view of what money is and essentially what banks are, had a number of implications. So one is the moral side of that. And on the moral side, you essentially have like the question of, should banks have the right to create money? And because if you can create money, you can decide also where that money goes to, right? So obviously today in an era of COVID, we have a lot of money printing in the world, and the central banks decide. Well, the private sector also decides where a lot of money goes to. And that, I outlined it in my book, that leads to preferences for in-groups versus out-groups. And it's just very clear wherever you look in the world that in-groups are privileged by being closer to a relationship with a commercial bank that can create money than out-groups. And that perpetuates inequality over time in every economy that you look at. And the other side of it is the policy implications, because if banks can create a substantial amount of the money in the economy, then there's issues about whether central bank policy, like money printing, makes a lot of sense. Because if you print a lot of money and most of that goes through the commercial banking sector, well, you can see in some of the graphs that I've published, like a lot of that doesn't work its way into the real economy. So you get back to some ideas of helicopter money is actually, more equitable and more effective because actually it gets into the real economy. But anyway, it started at LBS. It's kind of a fascinating look into, what banks actually do. And it has real world implications. I was watching a speech by Christina Georgievina, the IMF managing director, who recently talked about a new Bretton Woods moment. And it's really fascinating. The press release that they've got on their website starts and ends with a quote from Keynes. And I think Keynes probably had his, heart in the right place. But when you really look into it, if you really understand money, which I don't think Keynes did very well, you would realize that giving this kind of power to the commercial banking sector, has moral and policy implications. So that's the book. It's it really grew out of the amazing time that I had at London Business School and my curiosity to look at emerging markets. Because if you're in an emerging market, you see things differently. You see things in a more raw way that you don't see if you're sitting on Wall Street or if you're working in the city of London. Like, where does money come from? Well, money comes from central treasury, right? Nobody keeps asking, well, where does central treasury get it? Because the myth in the world essentially is that it's just, like the Boy Scouts, it's just really helpfully, connecting, surplus capital with uses in the economy. So anyway, I'm eternally grateful to London Business School. It definitely did what it said at the time, which was that it transformed futures. And for me, it was incredible to learn all of the amazing things you learn in the MSc in finance program. Like, the math was, the math underlying a lot of the financial theories, the philosophical approach to finance was probably the most interesting thing that I got out of the program. And then, kind of being a nerd, a professor helped me get a job to kind of try and explore the thesis that I had written about emerging markets. So, for a quite young guy who grew up in Canada, it was really eye-opening to end up in, a place like Moscow. And I was in China as well. And the same thing happened in China. I'm like, I kept saying, like, where does the money come from? How do we do this? And by then I had kind of like restrained myself a little bit more. It was a little bit less shocking. But for me, London Business School was definitely a transformative experience. And so I'm really delightful to present my little book to the book club.
Thank you, Robert. I'm sure there are many things that people want to ask you. If not, if they want some more time, then I do have a lot of. Okay. I have more questions than time for tonight. So, please, Stephanie.
No, Claudia, you go with your questions, and I'll go with whatever. I just had my quick one was what inspired him to write the book, really from a standpoint of something bothered you so much that you felt, I need to write a book about this, and actually you even set up a business around this. So I'm just wondering what emotions were going on in your head at the time when you were writing and writing and writing.
Yeah, thanks, Steph. So, the thing probably that drove me the most was a feeling of inequality. It's just, like many things in life, I think you have to be, what gives you meaning in life for many people is more than just finance. It's more than just writing a dry book saying, hey, look, banks create money. I think the implications of banks creating money and their role in the economy, which is shockingly not really put into a lot of the financial models, a lot of the economic models. A lot of leading Keynesians, they simply ignore the banking sector. And they do that because they come from the belief that it's just allocating capital. And that's not what it does. Banks are very active actors in the economy. And so they determine, who essentially gets money, whether you call it like, essentially fiat currency, or whether you call it like purchasing power. And I think the effect on the economy, the moral effect on the world is very negative. So that's what led me to it. I was just annoyed that as well, like, I live in Switzerland, and I don't have much to complain about. Life has been good. I mean, I had a really interesting career in banking, and I saw the world, and it was really intellectually stimulating. But it's just shocking to see the effect of the banking sector, I think, particularly on outgroups. And so, but it affects everybody. I mean, the savings, I've written an article called "The War on Savers." That's mainly because of central bank interference in the economy, and that banks are vampires, right? They live off of the economy. They live off of the hard-earned savings of just many average people. But even institutions like here in Switzerland, if you're a family office or a pension fund, you're managing a lot of money, you don't make anything on your money in the bank. And same if you're a hardworking person in emerging markets, your money doesn't work very hard for you. So I was kind of irritated by it. It might be because I went to LBS and I'm a little bit autistic, but I was like, I need to find some solution to this because it's annoying. So I thought, with a colleague, one of my oldest friend from Canada, who's got his doctorate in engineering, we said, let's find a technology solution to this and see if we can bypass the banks. And you can today. You can use blockchain technology, which is a distributed technology, essentially, to bypass the banks, and you can connect what you can do what banks are supposed to do, which is connect savings to uses of capital, and you get a higher return. But I guess I was just, anybody who looks into banking too much, there should be a trigger warning on it, because you end up getting really irritated. And the only way that we put up with banking, like many things in society, like low-level prejudice or whatever, is it's because of our preconceived ideas. Nobody, even people like us, people like me, as a myth, when I was doing my master's degree, I never looked at myself and said, what is money? It's only because I literally saw money being created out of thin air that you ask yourself. But you're a weirdo if you go around and say, hey, what's money? It's so that's what I guess I just got annoyed and stuff. So
thank you for that. We do have another question by I think Francois van Dyck. Given that you've read a lot about the origins of money, what is your take about the perspectives or opinions of Niall Ferguson? Any particular lesson taken from Ferguson?
Yeah, I think Niall Ferguson is an amazing historian. I mean, he's a very, very interesting guy. On the bookshelf to my left here, I actually have his History of Money. I've read his multi-volume House of Rothschild. I've read very widely on money, and I like Niall Ferguson. His problem, like many people's problem, is they never worked in a bank. And you actually literally need to work in a bank to see how it all works. Otherwise, you don't see it. It's like these economists. Like, I read some stuff from Paul Krugman, for example, it just drives me crazy, because I'd like to have his personal phone number. I can call him up and correct him, But it's like, if you just look at aggregate accounts, right, which is what these macroeconomists do. They just look at the aggregate and they say, this is how it is. I mean, you miss it. You don't see it. It's like it's like you need to literally be an insider. Or, for example, Ray Dalio is obviously a genius. He's one of the most impressive money managers of our time. What he's created at Bridgewater is amazing. I love his book Principles, but he doesn't get it either. Like, his video that he's put on YouTube, which is like how the economic machine works, when it talks about the role of the banking system, it repeats honestly the fallacy that has been written in economic textbooks since Paul Samuelson's textbook in 1948, which is that banks are basically like connecting surplus capital to productive uses in the economy. there's a money multiplier effect, and that's it. And that's not true. I mean, like, I literally have seen it with my own eyes. Like, I kind of, like, maybe if I hadn't seen it myself, you know what I mean? Like, maybe if I didn't go to London Business School and didn't take that degree and didn't do my thesis on valuations in emerging markets, I wouldn't have seen it, right? I would have been sitting in like London or New York, and, you know, I never would have said to myself, hey, what is money? But you only find that out if you work in a bank, and I think you really have to have seen it somewhere raw, like I did in Russia and China in the 90s, when it was really raw, right? It was as basic as you can get. It's like it's the equivalent of an economic textbook when you're like on a desert island and you've got two islands and one produces this and the other produces that, and they're better off if they specialize. It's like, yeah, but you don't see that working in like, you don't see that working in the city or working on Wall Street. And Ray Dalio doesn't see it. He's never seen it because he doesn't work in a bank. So
do you think basically they don't see it, or they don't need to see it, or the system works fine just as it is?
Yeah, it's a good question. I really think it's something that is in plain sight, and we just don't question many things that we see in plain sight. The world is so complex. There's so much information that comes at you every second. You know, just to survive, you have to use heuristics, right? The greatest economists are, the behavioralists. They're the people who say like, no, it's like, I remember when I was at LBS in 1998 when long-term capital management failed, and Ian Cooper, one of my favorite professors, who did corporate finance, he had worked with one of the two Nobel Prize guys who were on the board or advising LTCM, and like, he said, like, it's a perfect example of, you have like some of the smartest minds in finance and all of the incredible algorithms that back it up, looking at like how to trade stocks. But the problem is that, you know, human beings are difficult to figure out, right? I mean, you know, that's why I kind of like myself. I like numbers and coding and can't really figure myself out or other human beings. So I really think that, you know, Ray Dalio, he's a genius. I think he just, you know, it's like I said, the example of being a medical doctor, right? Like, I mean, or whatever, a finance graduate, you're functioning at a level where you're thinking of like, you know, you're thinking of like, you know, pricing sophisticated products, or like you're thinking of all the Greeks, right? Like you're thinking of like, what is gamma hedging? Like it's the whatever, do you know what I mean? It's the slope of the line, the rate of change of the delta of the option with respect to the underlying. You're not thinking like, oh, you know, what is money? That's why my colleague loved it. He's like, keep asking that question, Robert, because, you know, you'll get fired and I can, you know, move up easily, or, you know, more easily. So
I think maybe MJ, maybe you have the opportunity to ask the question directly, or I can ask it, because
Sure,
now I noticed.
Sure, I wasn't sure what the protocol was, but
either way works fine.
Okay, so what lies ahead in the future with regards to, one, cryptocurrencies and how the banks are going to react to them? Number two, as we continue to print money, you know, what's going to happen? When do we stop? You know, one crisis leads to another. You know, you say, okay, I'm going to print now, and then you print some more, and then you keep printing again. And then what?
Well, I think the answer to that is I try to address it in the very early part of my book, which is the history of money. And I think the answer to both of those comes out of the history of money. What is money? Because can cryptocurrencies be money? If you just keep printing all the time, like these, you know, nutcases, you know, who are running the central banks, or MMTers, I mean, you know, it makes it almost worthless, right? I mean, is money something that can be secured by advanced cryptography, like advanced mathematics, and store it on computers? Or can you just run a printing press, continually? And I think the answer comes from the history. And the history of money, I break it into two periods. One is a period where money was basically present value. So you worked for something, you did something, you specialized in something in life that was valuable in the economy, and essentially you sold that good or service based on your time, your specialization, and you received essentially a symbol for that. And that symbol rewarded you for the value that you had created relative to other things in the economy. And that basically is money, whether it's seashells or whether it's a coin or whether it's, anything else. I mean, that humanity has used this, a vast array of things. Eventually gold became quite widely accepted. And before government took over essentially printing paper money, gold really encouraged like international trade, because it was widely accepted and it was scarce. And money has all these stupid list of definitions, like has to be divisible, has to be a unit of account. I don't think it does at all. I think it needs two things. I think it needs to be scarce, and it needs to be accepted. I mean, money is more religion than anything else. It's a belief system, because if aliens show up tomorrow, like I say in my book, and want to sell us a cure for cancer, you can't hand them a stack of paper and say, here you go. Like, they're going to look at you and laugh, right? You can't hand them gold, because they're going to be like, yeah, on our home planet, we have atomic element 79 as well from exploded neutron stars. Like, why do you guys use gold, right? I mean, but they probably think to themselves, like, you guys could have cured cancer by yourself if you didn't like screw up your money system so badly. So, but the second part of that is much more sinister, because at a certain time in medieval, Italy, basically, gold depositories, figured out essentially that not everybody, basically gold is not easy to use as a currency because you can get robbed, and it's not easily divisible. And so a lot of these depositories would essentially hold gold, and they'd write you a paper IOU, like you've got 100 gold or something here. And that's much more convenient to use, right? Because you can take the paper, you can divide it in two, you can, it's much easier to use. And obviously, like, humans are ingenious at like being tricky. So essentially the gold depositories figured out that not everybody comes back for their gold tomorrow. And so what they can do is they basically have the ability to create purchasing power. So what they do is rather than saying, all the certificates are out there for the 100 gold, well, I can issue another couple certificates for 20 against that gold. And then the person who gets that 20 has purchasing power. And so now I have two things that are supporting my paper. I've got the gold, like the real present value. I worked and created something in the economy, which is the basis for all solid money. And I've got a future value, a stream of, for that 20, I've got somebody who in the future is going to put that money to work. They're going to use it. They're going to, whatever, in their business, they're going to trade. And then they're going to pay me, they're out of the, they take their 20 now, maybe they're going to make 30 out of it. They pay me back the 20. They've made 10. I've made, I've essentially leveraged what I'm holding at the bottom of my inverted triangle. That's my reserve. That's my fraction, which I hold. And so now I've changed the whole meaning of money. And so money has this fraction essentially at the bottom, which represents real value through specialization, through work that's been created, that is essentially exists today. And then I have also a future value, which is a stream of future cash flows to come in. And money becomes different. So money, the question is what I ask in the book is, what is money? Is it the gold that it's at the bottom? Is it now the paper certificates written on the gold? And so humanity basically has moved to a position where money is not just the present value of something that's really created, but it's also present value plus the future value, which banks can create themselves by acting as monetization entities. They give purchasing power today, in present value terms, in, you know, that can be used at the same as PV money in return for an obligation to pay back in the future. So, you know, it's a long answer to your question, but I think that one of the answers is to return to essentially hard money. And I think that's, you know, cryptocurrencies were created in, you know, everything has a reason in human history. I mean, there's a reason why Satoshi Nakamoto, whoever that is, created Bitcoin in 2009. And in his cornerstone, essentially, of what he built in the Genesis block was a article from the Times newspaper in the United Kingdom that was like a chancellor on the brink of a second bailout from banks. So whoever Satoshi Nakamoto is one of the three proverbial people in the world who understand money. That's what Keynes was referring to. So, you know, and where will the world go with more printing of money? I think that it's a formula for hugely increased inequality in the future.
Thank you for this answer. We do have quite a number of questions and very interesting ones. Could bypassing the banks with cryptocurrencies also have negative consequences on the traceability of money and have implications for money laundering? What is your opinion on this? Asked Thomas.
I think one of the criticisms of cryptocurrencies is that they can be used for money laundering, and I just don't think that's true. I think if you really understand coding, like I mean, I spend most of my life kind of doing coding or financial models or, you know, whatever. I'm quite a nerd. And if you really look into it, like if you're a criminal and you have a brain, you don't use a blockchain. Like you know, you use US dollars in cash, or you use Delaware companies and hide behind that. I mean, the blockchain is basically a giant shared record book that is open and can't be changed. And so it's quite easy to trace things that happen on a blockchain. In the early days, it's very unfortunate that there was one guy in particular that set up a Silk Road, something called the Silk Road marketplace. And, you know, I mean, it's 100% not his fault. It's our fault as human beings that it attracts some bad actors. But no, I think blockchain and I think distributed everything is a huge potential solution to the problems that we have from centralized organizations, which are much better placed essentially to enforce discriminatory policies. And they also have this, you know, they also give this godlike power essentially for money creation, which is outsourced to the private sector. I think more that you look into cryptocurrencies. I mean, my first thought about cryptocurrencies was that this is silly. And, you know, I mean, and I had the same idea. It's like, it's very like, it looks like it's full of scams. It looks like it's full of bad actors. And unfortunately, like a lot of it is, particularly in the early days, but it's like the internet in the early days too, right? I mean, I remember trying to explain the internet because I've always liked technology. And I remember trying to explain, you know, the internet to like, you know, your grandparents in the late 90s, and they're just looking at you that like the internet is only there for, you know, for pornography, and the only people who will ever use the internet will be, you know, you'll be perverts, you know, and nobody's going to put their credit card like online. And, you know, it's just early stage technology unfortunately attracts geniuses who understand coding, advanced mathematics, game theory, you know, and they make up a small part of it. It's the same as the internet. It attracts geniuses, and it also attracts a lot of like, you know, people who want to scam you. So, but I would say fundamentally, the secret sauce of cryptocurrencies like Bitcoin is that it has a fixed monetary supply. It's like giving independence to your central bank rather than like some banana republic government just printing their own money directly. But it goes so much further than that. It takes the temptation out of human hands. It just says it's fixed, so you can't keep printing it. You know, it's like, in my view, blockchain takes it from the internet era idea of like don't be evil to an advanced area where you say can't be evil, because it's just, you just programmatically, you mathematically don't allow yourself the temptation of printing more money.
Thank you for that. James asks about the future regarding blockchain. Which crypto assets, so I think what is the future regarding blockchain in general, and specifically maybe which crypto assets should we look for? Example, Ripple, XRP?
So, you know, my view of cryptocurrencies is that in one sense they're very advanced. Like it's you think it's this new tech thing, but from a monetary perspective, it returns us to an earlier age of humanity where we just exchanged goods like one for one. There wasn't this perversion that's introduced to the system by fractional reserve. So, you know, I mean, you should usually only be moral, I think, about those things that are, you know, that really touch your humanity. But I really genuinely believe that fractional reserve banking is like a cancer for humanity. Like it's just it brings out the worst in people. I think that it vastly accentuates the business cycle, the trade cycle, and I think that it also, you know, hugely increases inequality. I think it's really, you know, it's really unjust to give certain actors in the economy the ability to create purchasing power essentially from nothing, based on the fact that they have like a banking license from the government and a reputation, and the fact that most people just don't think deeply about it. You know, I mean, it's shocking to see like what can actually happen in the traditional banking space where people can just simply, you know, like the fines against Goldman Sachs just this week, you know, now exceed 5 billion for the scandal with 1MDB in Malaysia. I mean, it's so revulsive, you know, revolting when you actually get into the details of what Goldman Sachs did in that case, you know, with their senior officers flying to Malaysia and meeting secretly with a corrupt prime minister. And, you know, it's just, it's hard to believe it. It's kind of like COVID, right? Like if you wrote a book about it, nobody would believe it, right? Like somebody eats an undercooked bat and the whole world, you know, shuts down. I mean, it just sounds like a bad book. It's the same with like a lot of the things you get in the traditional banking system. So big picture, I think crypto doesn't allow us to be evil and essentially returns humanity to a stage before the gold guilds started writing IOUs based on gold. But actually XRP or others, I don't know it really well. I use crypto blockchain in a really, really simple way. And that is to help people make more on their money. And so what we do is we cut out the bank. We essentially do what banks do on the, I won't get into the details, but on the lending side of things, we insist that and we don't use fractional reserve, obviously, because blockchain is inimical to, I mean, fractional reserve. It was created, it solved a problem essentially that you couldn't double spend. So you can't, the amazing thing with the internet is that you can copy and paste anything and send it anywhere. And publishing costs for whatever, for written works, for videos, for music are almost zero. But you don't want that for money, right? You don't want to be able to like, you know, go copy paste and like send it to 20 different people. You want an assurance that you can only send it to one, you know, to one person, and that's the truth. So what we do is we essentially use the blockchain to cut out banks, and we insist that everybody goes through the blockchain, so there's a record of truth. You can't have double spending, and you'll be shocked if you cut out banks. You can easily, we give people a 3% rate of return in dollars, and it's insured. We insure it in the Lloyd's market in London because it goes through the blockchain. So everybody agrees this is just what is to be repaid, and if the borrower doesn't repay, we get credit insurance with Lloyd's. So I think these kind of things will be the best use of blockchain. But I'm in love with Bitcoin, even though it's a bit silly. and everybody accuses it of having like scammers and whatever. But for me, from a monetary perspective, it has a fixed supply of 21 million units, and nobody can print more. And I think that is just going to be invaluable. And the biggest people pushing Bitcoin and cryptocurrencies today are all the heads of the central banks. So we should thank them for it.
I have a very tough decision. There are so many more questions, and I also have mine, but I'll be generous and I'll read these questions and leave mine towards the end. You have experience in emerging markets, but how can we apply what you learned there to G7 developed countries? Is that even possible? I mean,
yeah, I have experience in emerging markets. But the story has a bit of a happy ending. After that, after I worked in Russia and China, I came back and worked in Europe, and I worked for Lehman Brothers, which was like, I used to be able to tell people, but then thank God, it's a sign for me that there is a God. I left before they blew themselves up and the world. So my view of emerging markets was not really specific to emerging markets. I think it's just that I never would have seen the rawness of how banks operate unless I was in an emerging market. So when I was in China, for example, we were doing the same thing. We were making loans to a number of companies. And again, I'm like, okay, well, do we bring this from our regional headquarters in Hong Kong? Like, how does it transfer? Like, I just wanted to know the plumbing of the financial system. Like, how does the money get here? And so, eventually finally the guy's like, look, kid, I create a loan account, I create a deposit account. They're both the same. And he's like, the guy's like, I create the money. So he's like, now beat it, get out of here. So, and I think where that applies in the G7 is just that there's, like I try to say in the book, like the first part of the book goes into like the history of money and banking. Then it goes into how banks, really work, which is not the Walt Disney version. It's like, I wouldn't, if I bought my own book and I hadn't had that experience, I'm not sure I'd believe it. And I only believe it because I lived it. I saw it with my own eyes. How does it apply in the G7? I think it has, like I say in the book, it has moral and policy implications. And the moral implications are fractional reserve banking leads to two things. It's just, it's hard to question it once you approach it from the angle of banks create money and once you understand how banks do it. And essentially those two moral issues are that, like, it leads to inequality. I mean, there's just no question about that. It's a way that it transfers money from the 99 to the 1%. And so that's the title of my book. And the other is that it exacerbates the trade cycle, the business cycle. So, and so that's the takeaway. And the policy implications are like, if banks are not just like the Boy Scouts in the economy, like if they actually like are active, participants in the economy, if they're monetization entities, then they act like the rest of us. They look forward and say, hey, is it a good idea to be like giving purchasing power today in return for the promise of future cash flows? And the answer is no. I published something else on our blog page that you can look at, which is like, don't expect banks to lend anytime soon. And it's just, if you go to the trouble of digging out all this call sheet data, which I did, and you look at like, do banks resume lending after the tech bust in 2000, 2001, or after the great financial crisis in 2008, 2009, it's just very clear. Banks don't increase lending, no matter where the interest rate goes. So you can lower the interest rate as much as you want. Banks are thinking to themselves, in the good times, I made a whole bunch of loans that are based on the future value. So I created value today, purchasing power today. I gave it to some guy. The guy went and used it on his project. And you know what? That project, I'm not going to get those future value cash flows to come back into my bank because like his project, whatever, pets.com didn't work out or something else stupid. Or like I loaned it to a bunch of people to buy mansions in California. They're just not going to able to pay that back, and the asset value has gone down. So that's the policy implications. Like, you know, don't think that by printing a whole bunch of more money and like particularly funneling most of it through the banking sector, that's gonna stimulate the economy. It's this Keynesian, you know, it's this Keynesian nonsense for people who never worked in the real world. You know, you know, one of the many problems with Keynes, one is he didn't study economics. He studied mathematics at Cambridge. Two, he never worked in the real world. And three, he just looks at it simply through aggregated accounts. If you look at it through aggregated accounts, you know, you're just not seeing reality.
Richard says he agrees that money is essentially about trust, but given the volatility of cryptocurrencies, they cannot be viewed as a reliable store of purchasing power. Do you agree? And he also adds separating blockchain from his cryptocurrency spawn. So basically, he asked whether being so volatile, can they be a store of purchasing power?
Well, I think the store of purchasing power shouldn't be looked at from a volatility perspective. I think it needs to be looked at from an amount of supply. So purchasing power is retained when you have a fixed supply. When you have a supply that's increased, if you look at the value of the United States dollar since the Federal Reserve was established at the end of 2013, the purchasing power of the United States dollar, you know, viewed through the Consumer Price Index in the US, has declined 96.3% from when the Fed was established to ensure price stability to today. So that's down 96%. The reason why the US dollar is more widely accepted is because other fiat currencies suck even more than the US dollar. So the thing about Bitcoin is that, you know, anybody who's gone to LBS is an expert in statistics. A low population set will naturally lead to greater volatility. So over time, yes, in the early days, Bitcoin and any other, you know, small population set asset, it needs to be adjusted for, obviously, if it was more widely accepted. But you'll see that Bitcoin volatility has been declining every year since it's been an establishment for the last decade or so, a bit more than a decade. And if you, I just actually today, because I was replying to somebody on Twitter, so just today, I actually used my Bloomberg terminal to do a regression on Bitcoin against the SPX index, the S&P index, over the last 2 years. And you can see that the raw beta for Bitcoin against the SPX index over the last 24 months has been 0.3. So that's the raw beta, and that's quite a low beta. That's a very low. That's a very, very low volatility, and the R squared is 0.01. So it's not correlated very much with the S&P 500 index, and it actually has, you know, relatively low 30% volatility is fairly normal, and it's declining. So, you know, the fact is that I feel a little bit silly defending Bitcoin, because when I first started looking at it, I thought, my God, it's a scam. And there was this, I was running my business in Switzerland. I was trying to figure out how to take my business elsewhere. So how to grow, like I run a financial services business. It's a regulated business. So I want to expand it globally. I want to have it everywhere in the world. So how do I do that? So we're looking at like expanding to the EU, and then it's like, you know, you pay lawyers a fortune, and their favorite word is no. Like, no, you can't do that. No, you can't do that. You know, your Swiss license doesn't allow you. Basically, that allows you to be in Switzerland. So I remember there was this younger guy, you know, working for me, and he kept saying, this is in 2018, early in the year, and Bitcoin kept going up and up, and he kept saying, you need to look at Bitcoin. You need to look at Bitcoin. And one day, as he's trying to sell me on Bitcoin, I noticed in his wallet, he's got like a Swiss lottery ticket, and I'm like, oh my God, this sums up the whole thing. I'd never look at it, you know. And then, you know, frustrated with, you know, with essentially the moats that exist in the traditional financial space. Like the banking system is neither right wing nor left wing. It's like a medieval guild. It works to protect its own. It works to keep out competitors. And like the reason why I liked blockchain is because it allows me to operate globally. The reason I like Bitcoin is because it has a fixed supply. So but you know what? Like, look, I've got like, I went to LBS. I've got gray hair. I usually wear a suit and a tie. Like, I'm not your average guy who's like, you know what I mean? Like these crypto types. But honestly, if you look into it, if you start asking yourself, what is money? What are banks? I've got a master's of science degree. I can figure it out. I guarantee you, it will lead you to seriously considering cryptocurrencies. And what's made it a bit more palatable for people in the traditional space is that Paul Tudor Jones, one of the brightest hedge fund managers, and a guy who's really an independent thinker, like he doesn't care what other people think. He added Bitcoin to his fund in the spring. Michael Saylor, who's the CEO of MicroStrategy, he just moved almost $500 million of his corporate treasury into Bitcoin to preserve his purchasing power. And he's not like a crypto guy. He's running a Fortune 500 company. So you will see that more and more, like Fidelity in the United States. They're a very old-fashioned firm. They do cryptocurrencies. They do custody. You can trade Bitcoin in Chicago. I mean, it's as we know from the program, like as financial depth increases, you will see a reduction in volatility. And the greatest thing is the looming threats on the horizon to human freedom, to liberty. It's central bank digital currencies. It's the inequality that you see in the world. A lot of that comes back to the banking sector. So
thank you for your answer. Richard says US dollar is a reserve currency. Saudi-US OPEC perpetual relationship, the majority of commodities priced in US dollar. How can this default level of trust be debased by a massively volatile cryptocurrency that doesn't satisfy the basic minimum currency characteristic of being a stable store of value? But I think partially you've addressed that. But in case you want to add this, because this is a different question, partially along the lines of something that was previously asked.
Sure. Well, like I said, I think volatility needs. I don't think it's as volatile as people think. I think the volatility is declining. I think, as we know from stats, the population set, as it increases, volatility will decrease. But there's no question that this is how I start my book. This is what money is. Money has to have a reference for exchange. Like when the guy essentially who made the spear and the guy who went out and did the hunting then sat down afterwards and said, how are we going to divide up the woolly mammoth? You have to have a yardstick. You have to have a reference. And so, that's where gold has served a role in the past. And there's no question since the Second World War, the United States dollar has been extremely good at essentially acting as like a reference for exchange. So 1 barrel of oil, what does that equal in terms of whatever, a basket of purchasing power? Well, it's easy to express that in US dollars. So I don't think that like we're going to have oil priced in Bitcoin tomorrow, that's for sure. However, I do think that people like Michael Saylor and Paul Tudor Jones, and increasingly people will say, as a store of wealth, putting it into whatever you want to call it, Bitcoin, you could call it anything else. It's just putting it into essentially a symbol that represents purchasing power, and you can't print more of that. Like it's not like some I mean, the Federal Reserve is the most anti-capitalist thing in the whole world. I mean, we delude ourselves to think that, that the West is a capitalist economy. I mean, it's the small cabal of government bureaucrats who set the price of money in an economy. It's insane. What Bitcoin does is it increasingly takes that power out of the government and returns it to people. And I think personally the government should get out of money the same way government got out of politics, got out of citizens' sex lives, etc. I mean, you only need to look at the decline in the value of like the dollar over time. You know, the one thing that is certain is that your purchasing power is going to go down. And everybody's very clear about that. I mean, they have an inflation target of 2% a year. That means that your store of wealth, so to speak, the US dollar, essentially declines in purchasing power terms on a targeted 2% a year. I know they're frustrated because actually technology is deflationary, because technology is about abundance and traditional economics is about scarcity. And it drives these Keynesian, you know, Politburo members nuts that essentially technology is actually making the world so much better. It's adding so much more abundance to humanity that you can't inflate away essentially purchasing power, because, you know, inflation is amazing if you're a borrower, and it sucks if you're a saver, and it's just the reverse for deflation. If you're, you know, so who are the biggest borrowers in society? Well, it's government and the banks. And who are the biggest creators of the money supply in the economy? Well, it's government and the banks. So what a surprise! They want it. They prefer an inflationary environment. And then they have this, you know, they have it backed up by Keynesian economics, which basically says we're the smartest kids in the room, and the solution is to inflate everything. And what a surprise that like government and banks love Keynesian, you know, economics. So I think that the question needs to be split into two parts. One is what is a yardstick of value, and then and the other one is like how do you preserve your wealth, your purchasing power.
Great. Thank you for all of these answers in details. I think, yeah, we have Stephanie's dad as well online, so hello. I will choose one question because time is actually up, but I don't want to keep everybody over the normal 60 minutes. But I would ask, so Bitcoin has gone from less than $1 to 12,000, I think recently even more than that, because quite recently, PayPal announced that it's gonna allow using it and trading it. So do you think this is fair that some people get so rich because they held on to Bitcoins they made 12,000x if they held Bitcoin value over, let's say, 12 years?
Well, that is a really good question.
I mean, sorry.
That's a really
half jokingly, because I'm saying, in a way, it's half serious, half joking question. I mean, to frame it in a more serious way, doesn't that mean that those who are invested in Bitcoin and cryptocurrency, if they go up, they will become much richer than the others who are not part of this, let's say, change or revolution?
Yeah, you know, it's a really good question, because I'm definitely not saying that cryptocurrencies or Bitcoin are perfect. I'm simply saying they're like 100x better than the current system. But you know, you're right. Some early people mined Bitcoin, and you know, if you held on to it and it's gone up like such an incredible amount, you might argue that you've unfairly benefited from it. One of my favorite stories is that who's the economist? There's quite a well-known economist. It'll come to me in a minute. I had his textbook when I was at LBS. He's obsessed with chess, and he's bald, and he hates Bitcoin. And he doesn't hate it, but he's like, you know, he doesn't see the value in it, because like everybody, he makes a lot of mistakes unless you've read my book. You know, no money has any intrinsic value. I mean, it's just a symbol. It's just a symbol of purchasing power. It's not like your flimsy paper thing with the queen's face on it has intrinsic value. It's just silly, you know. But anyway, I remember what's his name? Anyway, he had some funny story about like his daughter is obviously like, he's a smart guy, so, you know, his wife's smart, he's got a smart family, and so their like young daughter, they found her, and she was like in her bedroom, and she was mining Bitcoin. you know, which is kind of what you want your kids if they're up to something kind of suspect. Like, so she's kind of figuring out, you know, computer programming, and she ends up like, this is years ago when you could actually mine Bitcoin on your laptop. So she mined a bunch of it, and then she said to her dad, who's like this famous economist, like, you know, what should I do? What should I do with it? And he's like, oh, there's no intrinsic value. You should sell it. She said afterwards, she felt like suing him because now it's gone up like, you know, whatever, you know, 10,000x. So yeah, I think that Bitcoin is up. I think that it will continue. I think it will continue to increase. And the biggest drivers of the Bitcoin price going up are central banks printing money like never before in human history. And then it's like the threat of central bank digital currencies, which basically, you know, the too long didn't read version of CBDCs are that it would allow centralized authority to put an on-off switch on your cash. And you don't have to be like a crazy libertarian to like perhaps not want that, or perhaps to see that the most vulnerable in society, the out groups, are probably going to suffer the most. So, but is it perfectly just that these early people who held on to it, like hopefully this economist's daughter, you know, it's a shame she didn't, I guess, maybe she held on to some of it, you know, but are they justified now that it's gone up so much? I mean, probably you could argue no, that they're not. So, and then it gets into a question of like, how would you fairly distribute money? And I don't have the answer to that.
Thank you very much, Robert. Thanks for this answer to a very tricky question, and appreciate it. I think it was a beautiful evening, and we all have some food for thought. And we would like to thank everybody who participated tonight. And please, over the MIF Telegram group, or get in touch over LinkedIn with me, with Robert, and hope everybody is happier and has learned something tonight, or at least has had his or her ideas challenged tonight.